Hi, I'm Adrian Walker. This is the Walker Report, and I am wearing a cravat today. I own a cravat. I've decided to wear it because I'm in basic lockdown and no one can stop me anymore. This is happening. This is going to be hopefully one of 3 videos that we do this week. I just want to quickly review what's happened in the past week because I think that was a very interesting week in terms of what the markets did and how they responded to a lot of very positive stimulus news. We'll do one more video sort of tying into the general themes of what the last video discussed, which is where I was looking at why you shouldn't sell in bad markets, and instead I'm going to talk a little bit about what happens when you do have to sell in bad markets and how you make those decisions. And then hopefully I'd like to do, if we can fit it into the schedule this week, it's very hard to say, but if I can, we'll fit in a video that just talks a little bit more generally about what should or maybe we should consider happening after we get out of this particular pandemic situation. Because I'm not convinced that the stimulus that we've already lined up will be sufficient. So, there you go. So what happened last week? Monday, we reached some pretty significant lows on the market. And if you didn't think that markets could get low enough, well, they could go lower. And then Tuesday, very suddenly, we had an enormous surge in investor confidence. Now, what's interesting is that we didn't yet have a stimulus deal out of the United States. They were still negotiating. And there was a lot of confidence in the market that a $2 trillion stimulus deal would get done and would get signed by the president. It would pass through both houses of Congress. And that did come. And then by Friday, once the stimulus deal was in place, markets began to sell off again. And I think there's an interesting idea here that we should consider, which is that last week may be more telltale about what things look like going forward and what we may come to expect, because it's probably too early to see that we're going to have a recovery. That was very premature last week, and I think it's understandable as to why. We don't really have a clear economic picture yet of just how significant damage is. We don't really know how big a hit the economy has taken. We're not actually sure just how much capital has been lost. And as I was describing this to another client last week, I said, if you assume that you're a small business and you run a barbershop and for 3 months you don't cut any hair, and you've got money going out the door in leases and in taxes, you can defer some of that. Perhaps maybe you've got a good arrangement with your landlord. But when the doors do open again, there will be a backlog of demand for haircuts. But when people come in, whereas they would have had 1 haircut a month, they're only going to get 1 haircut. So there's 3 haircuts lost and only 1 haircut gained. So there is a real loss of capital there. And that's going to happen to a lot of things throughout the economy. There will be pent-up demand for purchases that we know were going to be made. But there'll be a number of things that just can't be replaced, especially in the service sector. So the size and scope of the economic fallout from this is just not yet, I think, something that we can map or accurately track. And I think that that's going to be a big part of what's going to influence markets, because we will get pictures, we will have updates coming to us from banks, from large corporations, we will have pictures of their financial health that will become clearer over the next few months, and the markets will probably react to that very negatively. I would be very surprised if at this stage we're ready to start piling money back in for a recovery. So what did happen last week, I believe, is that we got to a point in the markets where we effectively ran out of enough sellers, and the price on a number of very, very good companies became so appealing that the number of buyers just overwhelmed them, and that gave a big rally to the market. And you could see by Friday, after we'd shaved off something like 15%, so we were down, at the beginning of the week, we were down something like 35% year to date on the Dow. By Thursday, we closed at the end of that day, we were something down like 20% on the Dow. That's a pretty shocking move. That was thousands and thousands of points that had been wiped out, re-added. But then Friday, we saw about 1,000 points come off the Dow again. And I'm only using the Dow because it's a very helpful indicator. Everyone seems to know it. And it's not necessarily the most accurate or the most helpful. But in this instance, it's been a pretty good bellwether for the direction of markets. So what's likely going to happen? I think we may find a bit of a floor at around 18,000 points, very possibly. Don't quote me, I'm not advising that that's where the floor is going to be, just that it seems like that may be where a floor is. That's where there's some enough buyer resistance that, you know, we get rallies at that point. But we're more likely to continue to retest, continue to dip down, and have periods of sudden surges of optimism brought back down by sudden surges of selling again. And I think that we'll go through some of this for a prolonged period of time until we can begin genuinely getting on the other side of the pandemic. Because as I wrote the other week, it doesn't matter about the stimulus. You can defer taxes, you can give mortgage relief to people. All of that is very helpful, but fundamentally people must go out into the economy and spend money, and right now they can't spend money. And that is the chief problem. A huge amount of just the general economy has been curtailed, and there is no fix for it until we get back out and we're outdoors and we're able to interact and we're comfortable going to our businesses and our restaurants and our offices. All of those things make the economy go, and we aren't there yet. So please keep in mind, if you were worried that there were opportunities to buy last week and you missed out on them, I wouldn't be surprised if we retest some of those lows. If you're interested in putting money to work, I've talked to a number of people. I'm surprised at the amount of confidence that we have that we're going to get good buying opportunities. That's very encouraging. Make sure that it follows a plan and that you understand the nature of the risk and how much risk you can take, because you're obviously deploying cash if you've got it on hand, and you're going to reduce your potential liquidity. So I'd like you to, if you have any questions for me, please feel free to call me or send me an email. Our next video, I'll try and have that out in the next day or so, talking a little bit again about what happens when you do need to redeem money in bad markets, and then hopefully one more video for the week. Again, I'm Adrian Walker. Yes, I'm wearing a cravat. No one is here in the house to stop me at the moment, so there we go. And please like and subscribe if you want to keep up to date with our videos. Don't forget about our blog, The Walker Report, and thank you very much for watching. Cheers.